Most UAE residents are sitting on the wrong amount of emergency savings, and they have no idea. Not too little, not too much, just the wrong number, built on rules made for a completely different country. The classic advice says save 3 months of expenses, but in the UAE, 3 months can run out before your visa issue is even resolved. Today we are going to fix that. By the end of this video, you will know exactly how much emergency cash you personally need as a UAE resident in 2026. We will break it down by city, by family type, by income bracket, and by whether you are salaried, freelance, or running your own business. And we will tell you where to actually put that money so it does not silently lose value while it sits there. There are 4 things most people get badly wrong about emergency savings in the UAE. We are going to cover all 4 and give you a real number you can act on today. Let us start with the number 1 mistake people make before they even calculate anything. Most residents look up a generic personal finance guide, see 3 to 6 months, pick 3, and move on. That rule was written for someone with a local passport, a government safety net, and no visa countdown ticking in the background. That is not you. In the UAE, losing your job does not just mean losing income. It can trigger a visa cancellation clock, a school fee deadline, and a relocation decision, sometimes all at once. UAE residents are given a grace period that can reach up to 6 months after a resident's visa is canceled or expires. That alone already tells you that a 3-month cash buffer may be gone before the paperwork problem is even solved. And if you use the job seeker visa while you search, that runs for 60, 90, or even 120 days on top of that. The real emergency window for an expatriate in the UAE is not 3 months. It is often 6, 9, or 12. So let us build the right number for your situation, starting with where you actually live. Here is something the generic advice completely ignores. Your emergency fund target in Sharjah is almost half what it needs to be in Dubai. That is not an exaggeration. That is just the cost of living data. A single professional renting a 1-bedroom apartment outside the city center in Dubai faces about AED 9,572 a month in total living costs. The same profile in Abu Dhabi is about AED 8,351. In Sharjah, it drops to about AED 6,008. In Ras Al Khaimah, it falls further to about AED 5,085. So a 6-month emergency fund for a single Dubai renter needs to be roughly AED 57,000. For the same person in Ras Al Khaimah, that 6-month target is closer to AED 35,000. Same rule, completely different number, depending on where you actually live. Now add children to this equation, and the math changes dramatically. A family of 4 in Dubai, renting a 3-bedroom apartment outside the center, already burns through about AED 26,300 a month before anyone sets foot in the school. Add 2 children in international primary school, and that monthly number jumps to roughly AED 36,800. A 6-month fund for that family is not AED 50,000. It is closer to AED 221,000. And if you are in a Dubai city center flat with the same 2 kids, the 12-month target crosses AED 506,000. Those are not worst-case numbers. Those are the actual costs pulled from current data for real UAE households. In Abu Dhabi, a 4-person family with 2 primary school children faces about AED 31,060 a month. That puts their 6-month target at roughly AED 90,000 and their 12-month target at nearly AED 380,000. In Sharjah, often chosen specifically because it is more affordable. The same family profile with 2 school-aged children still needs about AED 28,000. These numbers are not meant to scare you. They are meant to give you an honest baseline so you stop undersaving without knowing it. Now let us talk about the factor that trips up almost every expatriate family: school fees. This is the biggest hidden cost in UAE emergency fund math, and most guides skip over it entirely. Dubai's average international primary school costs roughly AED 63,087 per year. That is about AED 5,257 every single month per child. In Abu Dhabi, the equivalent is about AED 54,787 a year, or AED 4,566 a month per child. Even in Sharjah, international primary school runs about AED 32,873 a year, roughly AED 2,739 a month per child. And Dubai's education regulator set a cost increase index of 35% for 2025-26, so these numbers will keep drifting upward even when general inflation looks calm. Here is the brutal math. If you lose your income and you have 2 kids in Dubai schools, you are spending nearly AED 10,500 a month just on school fees. before rent, food, or transport. A 3-month fund does not cover that. It gets consumed before the visa situation, the job search, and the housing decision are anywhere close to resolved. Now let us talk about something that lulls a lot of UAE residents into a false sense of security: the unemployment insurance scheme. The UAE's job loss insurance, ILO, sounds like a real safety net, and it is some help, but it is not a substitute for a proper emergency fund. Here is why. ILO pays you 60% of your average basic salary, not your full package, just the basic. If your total monthly compensation is AED 30, 000, 0ED 12, 00000, ILO pays you AED 7, 200 a month. The cap for most subscribers is AED 10,000 per month, and it only pays for a maximum of 3 months per claim. So even in the best case scenario, ILO gives you 3 months of partial income replacement, while your actual monthly expenses keep running at full speed. This is why financial advisors who actually work in the UAE consistently say the emergency fund should start at 6 months, not 3. Sarwa explicitly calls a 6-month fund the best protection for UAE residents. ADCB says 3 to 6 months and recommends leaning toward the higher end. That guidance exists because they understand the visa-linked risks that generic advice ignores. Now let us look at what the right emergency fund target actually looks like, broken down by the type of resident you are. If you are an Emirati household with low fixed costs and access to public healthcare, 3 to 6 months can genuinely be adequate. GCC citizens have universal coverage in public healthcare facilities with minimal out-of-pocket costs, so the medical expense wildcard that catches expatriates is much smaller for national households. If you are a salaried expatriate without children, 6 months is your minimum. 9 months is the safer target if you are in Dubai or Abu Dhabi. The math supports it. A single Dubai renter's 6-month buffer is about AED 57,000. Going to 9 months takes that to roughly AED 86,000. That extra AED 29,000 buys you real breathing room during a job search that might take longer than expected. If you are an expatriate family with children in private school, 9 months is more realistic than 6, unless you have a second strong income coming in consistently. The combination of school fees, rent, and the multi-layered visa and relocation risk means 6 months can disappear before the family situation stabilizes. If you are a freelancer, entrepreneur, or business owner, 12 months is the most defensible target in the UAE. Live, which has studied the UAE market specifically, recommends 6 to 12 months for the self-employed. The reason is simple. Your income can stop before your expenses do, and your variable cash flow makes predicting your actual emergency window nearly impossible. If you are a retiree living in the UAE, 12 months is also prudent, especially if private healthcare costs and rent are both significant fixed monthly outgoings. Now let us move to the part most videos skip entirely, where you actually put this money. Because here's the thing, having the right amount in the wrong place is its own kind of financial mistake. On AED 500,000 sitting in a standard Emirates MBD savings account, you earn roughly AED 2,500 a year. That account pays between 0, 25% and 0, 50% on AED balances. On that same AED 500,000 in one of the better options available right now, you earn dramatically more, and your money stays just as liquid. Let us look at the real options available to UAE residents in 2026. For first-line emergency cash, money you might need tomorrow, you want instant access with no penalties for withdrawing. FAB iSave is currently one of the strongest options for pure liquidity. It pays 4.00% per year on new funds until the end of August 2026. No minimum balance. No restrictions on the number of withdrawals. That is the kind of account where your emergency fund earns meaningfully without any strings attached. Mashrek Neo Plus Saver pays even higher. 6.25% per year, but it comes with a catch. You need either a salary transfer of at least AED 10,000 or a monthly average balance of AED 50,000 or more. And if you make more than 2 debit transactions in a month, you lose all interest for that month. So this works very well as a high-yield holding account if you treat it as a true emergency reserve and resist the urge to touch it casually. For contrast, the HSBC Standard Savings Account pays 0.01% on AED balances. That is not a typo. On AED 200,000 emergency fund, the difference between 0.01% and 4.00% is roughly AED 79998 a year. That money is simply being left on the table. For the second layer of your emergency reserve, money you would not need for at least a few weeks. A money market fund is worth considering. The Fundstar Emirates Money Market Fund returned 17% in 2025, with daily dealing explicitly designed to beat traditional bank deposit rates while staying liquid. For Sharia-compliant options, the Emirates Islamic Money Market Fund returned 25% in 2025 and 8% over the trailing 12 months to May 2026, also with daily dealing. And for a fixed tenor Sharia-compliant option, DIB's monthly profit payment Wakala offers expected rates from 60% for 3 months up to 50% for 12 months, but requires a minimum of AED 25,000 and locks the money in for the full term. That makes the Wakala a better fit for a second-tier reserve, not first-line emergency cash. The key principle here is simple. Split your emergency fund into 2 layers. Layer 1, 1 to 2 months of expenses in the most liquid, accessible account possible. That is your same-day money. Layer 2, the remaining 4 to 10 months in a higher yield account or money market fund where it earns more while staying reachable within a day or two. This one decision, done properly, can add thousands of dirhams in returns every year for 0 additional risk. Now let us cover the one risk that could undo all of this planning: the medical wildcard. A lot of UAE residents assume mandatory health insurance covers them fully. It does not. Dubai's Essential Benefits Plan has an annual aggregate claims limit of AED 50,000. Serious illness can push costs above that ceiling and leave you personally responsible for the excess. Even within that limit, the EBP includes copays, coinsurance, annual caps on drugs, dental, and mental health, and a maternity benefit capped at AED 10,000. UAE healthcare data shows that out-of-pocket costs represent around 13% of total health expenditure nationally, even with mandatory insurance in place. This is not a reason to panic. It is a reason to include a medical buffer in your emergency fund calculation, especially for families with young children or older household members. We are close to the end now. Let us pull everything together into a simple framework you can apply today. Step 1. Identify your household type: single, couple, family with children, freelancer, or retiree. Step 2. Identify your city. Dubai and Abu Dhabi demand larger buffers. Sharjah and Rak give you more room. Step 3. Apply the right multiplier. Emirati household with low fixed costs, 3 to 6 months. Salaried expat without children, 6 to 9 months. Expat family with private school children, 9 months minimum. Freelancer, entrepreneur, or retiree, 12 months. Step 4. Calculate your actual monthly burn rate. Include rent, utilities, school fees, transport, food, insurance copays, and domestic staff, if applicable. Step 5. Multiply that monthly number by your target months. That is your emergency fund goal. Step 6. Move what you already have into the right account. Layer 1 in a no-restriction instant access account. Layer 2 in a higher yield savings account or money market fund. If you are starting from 0, do not wait until you have the full amount. Start with 1 month, then build to 3, then 6, then the full target. A partial emergency fund is infinitely better than none, and it stops getting more expensive to build once you get started. Here is what this all comes down to. The UAE is one of the most financially attractive places on the planet to live and work, but it comes with a very specific risk profile that generic Western personal finance advice was never designed for. Visa-linked job loss, school fee continuity, relocation costs, insurance gaps, a labor insurance scheme that covers only a fraction of your actual expenses for only 3 months. All of that means your emergency fund has to work harder and last longer than what most guides tell you. The numbers are larger than people expect, but so is the peace of mind when you actually have the right amount sitting in the right place. If you want to go deeper on where to build real long-term wealth once your emergency fund is fully stacked, we have a video that covers exactly that, and it is where most UAE residents should go next. We will see you there.